At 10:11 a.m. on a quiet morning earlier this week, a small X account with barely 1,000 followers posted a rumor. The White House might be pausing tariffs for 90 days. Within minutes, the market surged. CNBC ran with the headline, and major market alerts started going off around the world. The problem is that it wasn't true, at least not at the time of the post. By the time the White House denied it, billions of dollars in trades had already been executed, all triggered by a single unsourced post. No whistleblower, no inside leak, just a misinterpreted TV interview amplified by a fake Bloomberg handle and a blue checkmark that anyone can now buy. This is why today I want to talk about how the rise of social media and the rapid spread of information it enables can move literally billions of dollars. But before we get into it, if you find any part of this video helpful or insightful, please like and subscribe. It really helps out the channel. Social media is now one of the most powerful information weapons in financial markets. What once required regulatory filings, official press conferences, or leaks to news outlets like the Wall Street Journal, they can now happen in real time, triggered by something as innocent as a meme account with a misleading username. The democratization of information has collided with the commodification of attention, and that tension is reshaping how markets react, who makes money, and who loses money. Today, we're diving deep into a crucial question. Can social media, with all of its speed, scale, and incentives, now be considered a form of market manipulation? Or are we simply witnessing a new era of crowd-led price discovery, as messy as it might be? To understand the scale of this shift, let's zoom out a little bit. In 2013, a single tweet from the Associated Press claiming that President Obama had been injured in an explosion at the White House caused the Dow to drop 143 points in only 2 minutes. The tweet was obviously false. The AP's account had been hacked by a group claiming to support the Syrian Assad regime. But the bots and algorithms didn't care. They traded on the headline anyway. Fast forward to 2021, the subreddit Wall Street Bets on Reddit ignited a short squeeze in GameStop that shook hedge funds and prompted congressional hearings. What started as a meme turned into a multi-billion-dollar repositioning of capital, powered by collective action and a shared sense of sticking it to Wall Street. Then came Elon Musk's tweets moving Tesla stock, then Dogecoin, then even more after the release of paid blue checks on X that made parody and impersonation indistinguishable from official accounts. A Spruce survey from just last month shows that more than 68% of Gen Z investors are influenced by financial sources on social media. Now, I'm not saying that's a bad thing, but it does open up a door to the movement of money based on poor quality and misleading information. All of this brings us to the events of this week. The post originated from an account called Hammer Capital with only 1,000 followers. It cited no source, just a vague implication that Trump might consider pausing tariffs for 90 days. The rumor, however, quickly spread. At 10:13 a.m., a much larger account, Walter Bloomberg, copy-pasted the message. That account's name, of course, mimics the Bloomberg financial brand. Bloomberg, as in the company founded by Michael Bloomberg, is one of the most trusted financial information services in the world. Traders rely on it, algorithms scrape from it, and its alerts move markets. So when an account named Walter Bloomberg with over 800,000 followers and a history of posting breaking news posted the headline, people believed it. CNBC, seeing the sudden market move, echoed the rumor on air. Reuters followed. By 10:19 a.m., it was being treated as though it was confirmed news. But then the White House denied it. And what followed was total whiplash. Markets corrected, Reuters pulled the alert, the Walter Bloomberg account deleted the post and claimed it originally came from Reuters. Trust me, you won't be able to find the original post on Walter Bloomberg's profile, I checked. Hammer Capital also backtracked, saying they were merely echoing what they saw on trading desks. So who's to blame here? Well, let's be clear, this wasn't an obvious pump and dump. There was no clear evidence of coordination, no massive options positioning ahead of time, but it was a failure of market infrastructure, of verifying sources before acting, of blindly trusting virality over veracity. And it raises a serious question. Where do we draw the line between democratization of market-moving information and the weaponization of social media for financial gain or just for the meme? Some argue that this is simply the new reality of modern markets. Speed matters. It always has. And in an age of zero-commission trading, crowdsourced sentiment, and 24/7 financial content, it's inevitable that mistakes will happen. After all, the stock market has always run on narratives, whether it's an analyst upgrade, a whisper number ahead of earnings, or a misread headline. Human psychology and information asymmetry have always driven volatility. So perhaps the issue isn't the platforms, but the people. Should traders really be executing billion-dollar positions based on an unverified X post? Should news desks really be putting up banners before confirming with a primary source? You could argue that this isn't a case of manipulation, it's a case of bad judgment, amplified by a new ecosystem where anyone can be a publisher and everyone has an incentive to be first. The Walter Bloomberg account benefits from every like, retweet, and engagement. The larger the following, the more influence. The more influence, the greater the opportunity for monetization, either through sponsorships, paid subscriptions, or in some cases, direct trading gains. And the new X algorithm actively rewards paid users. For $8 a month, anyone can get a blue check, prioritized visibility, and the appearance of credibility. That changes the game a little bit. Suddenly, a random user with no track record and no oversight can inject a false narrative into the veins of the global economy. And this isn't just hypothetical. According to the National Bureau of Economic Research, false and misleading tweets have had a statistically significant impact on stock returns, especially for small cap equities. In this environment, the line between free speech and market manipulation is becoming increasingly blurry. So where are the regulators in all of this? Well, the SEC has historically focused on traditional forms of market manipulation. That'd be insider trading, pumps and dumps, spoofing, front running. But social media fueled disinformation falls into kind of murky waters. Was there intent to deceive? Was there a financial gain? Was there coordination? If not, then under current law it might not meet the threshold for enforcement. But the impact is real and repeatable. This isn't just about fake headlines. It goes way deeper than that. Deepfakes of CEOs saying things they never said, AI-generated earnings reports, fake screenshots of SEC filings. The technological arms race between authenticity and virality is escalating. And the regulatory frameworks, which frankly I do not think are designed for the technological era, they're struggling to keep up. So where does that leave us? Well, first, traders and investors have to adapt. Trust but verify is no longer enough. In this new era, verify before you trust is the name of the game. Second, platforms like X need to rethink their role. When a single tweet can move markets, you're not just a social network. You're a financial infrastructure, and with that comes a lot of responsibility. Third, regulators need to evolve. The line between market commentary and market manipulation is blurring, and the enforcement playbook needs to reflect that. But most importantly, we as investors need to sharpen our skepticism. Because the next verified X account might not just misread a TV interview, and by the time the truth catches up, the damage might already be done. Now, I'm not trying to instill fear here. In fact, this did end up coming to fruition. At the time of recording this, the Trump administration is placing a 90-day pause on reciprocal tariffs. But that's not really the point. This should be a bit of a wake-up call. The markets are changing. The information flows are faster, less verifiable, and more prone to manipulation than ever before. And while social media has opened up access and flattened hierarchies, it's also eroded some of the guardrails that once protected investors. So the next time you see a viral headline, a breaking news post, or a market-moving rumor, ask yourself, who benefits? Who's behind this? Is it true? Because in the age of digital speculation, the greatest investment strategy might be as simple as knowing when not to believe the hype. Guys, if you enjoyed the video, please hit the like and subscribe button. It means the world to me. And until next time, have a good one.